Welcome to EXOUSIA Investing TV. Ever wondered how mortgage rates are determined? Well, you're not alone. Mortgage rates are like the heartbeat of the home buying process. They pulse with the rhythm of the financial market, keeping time with the economy's ebb and flow. At its core, a mortgage is a loan you take out to buy property or land. It's a long-term commitment, often stretching over 25 to 35 years. Now imagine this mortgage loan as a product. The price you pay for this product is the interest, also known as the mortgage rate. Just like the price of apples in a grocery store, mortgage rates fluctuate. They rise and fall, influenced by a myriad of factors such as inflation, economic growth, and the housing market. These factors are like the invisible hands, constantly shaping and reshaping mortgage rates. In the next few minutes, unravel the mystery behind mortgage rates. Because understanding these rates is key to making savvy home buying decisions. Stay tuned. First, let's decode the basics of mortgage rates. A mortgage rate, at its core, is essentially the interest charged on a home loan. This interest rate is expressed as a percentage. Why is it so crucial? Well, it's the price you pay for borrowing money to purchase a home. Imagine you're buying a house worth $300,000. You've saved up for a down payment, but you still need to borrow the remaining $200,000. The mortgage rate determines how much you'll pay in interest over the life of the loan. A lower rate means less interest to pay, and a higher rate means more. But it's not just about the total cost of your home. Mortgage rates also impact your monthly payments. A lower mortgage rate means lower monthly payments, leaving you with more money in your pocket each month. Conversely, a higher mortgage rate will increase your monthly payments. To put it in perspective, let's say you have a 30-year fixed-rate mortgage on that $200,000 loan we talked about earlier. A 0.5% difference in your mortgage rate could mean a difference of nearly $60 in your monthly payment. Over 30 years that adds up to more than $20,000. So, understanding the basics of mortgage rates is about more than just knowing numbers. It's about understanding how those numbers impact your life, your budget, and your long-term financial goals. Remember though, that mortgage rates are not set in stone. They can fluctuate based on a variety of factors, which we'll delve into in the next scene. These factors can include everything from changes in the economy to your personal credit score. That's why it's so important to understand the basics. The more you know, the better prepared you'll be to navigate the world of home loans and make smart decisions that align with your financial goals. Knowing the basics is vital to understanding how mortgage rates work. What are the elements that sway mortgage rates? This question is more pertinent than ever. To understand the changing tides of mortgage rates, we must first delve into the key factors that influence them. Let's begin with the Federal Reserve's policies. The Federal Reserve, or the Fed as it's commonly known, has a significant influence on mortgage rates. When the Fed increases the federal funds rate, banks and other lenders usually raise their interest rates to keep pace. Conversely, when the Fed lowers the rate, mortgage rates often follow suit. But remember, it's not a one-to-one correlation. Next in line is inflation. Inflation is the rate at which the general level of prices for goods and services is rising. When inflation is high, lenders typically charge higher interest rates to compensate for the decrease in purchasing power of the money they'll be repaid in the future. Thirdly, we have housing market conditions. If the housing market is booming, demand for mortgages increases. This can lead to higher mortgage rates as lenders capitalize on the high demand. On the other hand, if the housing market is sluggish, demand for mortgages decreases, potentially leading to lower mortgage rates. Finally, let's not forget the borrower's credit score. Your credit score is a measure of your credit worthiness, or in simple terms, how likely you are to repay your debts. Borrowers with higher credit scores are often offered lower mortgage rates because they're seen as less risky to lenders. Conversely, borrowers with lower credit scores typically face higher mortgage rates. Each of these factors plays a unique role in shaping mortgage rates, yet they are all interconnected, creating a complex and dynamic system. They ebb and flow, much like the tide, influencing the cost of borrowing money to buy a home. So, to sum it up, the Federal Reserve's policies, inflation rates, housing market conditions, and your credit score are the primary drivers of mortgage rates. These factors determine whether mortgage rates rise or fall. Different types of mortgages come with different rates. Let's dive into the world of mortgages and explore the various types available, along with the rates they carry. One of the most common types of mortgages that you might come across is the fixed-rate mortgage. As the name implies, the interest rate in a fixed-rate mortgage doesn't change over the life of the loan. This type of mortgage provides a sense of security, knowing your monthly payments will remain constant, regardless of market fluctuations. Now let's explore the adjustable rate mortgage, often referred to as an ARM. Unlike fixed-rate mortgages, the interest rate on an ARM changes over time. These rates are typically tied to a specific financial index and can go up or down based on market conditions. The initial interest rate is often lower than that of fixed-rate mortgages, making ARMs attractive to borrowers looking for lower initial payments. However, it's essential to understand that your rate and monthly payments can increase significantly over time. Then there's the interest-only mortgage. In this type, for a set period at the beginning of the loan, you're only required to pay the interest. This makes for lower initial payments, but once that period ends, you'll start paying off the principal, which means your payments will increase. Another option is the hybrid ARM. It's a combination of a fixed rate and adjustable rate mortgage. It starts with a fixed interest rate for a certain period and then switches to an adjustable rate for the remainder of the loan term. Lastly, we have the balloon mortgage. This type involves making small payments for a certain period and then a large or balloon payment at the end of the loan term. Each of these mortgage types has its own set of rates and potential benefits depending on your financial situation and long-term housing plans. It's crucial to understand these differences as they can significantly impact your monthly payments and overall financial health. Choosing the right type of mortgage can help you secure a better rate. Now, how can you secure the best mortgage rate? Let's dive right in. Firstly, maintaining a good credit score is paramount. Lenders use your credit score as a measure of your financial reliability. The higher your score, the more likely you are to get a lower interest rate. So, if your credit score is less than stellar, consider spending some time improving it before applying for a mortgage. Pay your bills on time, reduce your overall debt, and avoid applying for new credit to give your score a boost. Secondly, consider making a larger down payment. The more equity you have in your home from the start, the less risky you are to lenders. A down payment of 20% or more could help you secure a lower rate. However, this isn't always feasible for everyone. If you can't afford a large down payment, don't worry. There are many loan options available for those with smaller down payments. Next, it's crucial to shop around. Don't just accept the first rate you're offered. Different lenders have different criteria and can offer different rates. So, take the time to talk to multiple lenders. Compare their rates and terms, and don't be afraid to negotiate. You could save thousands over the life of your loan by securing a lower rate. Lastly, consider the length of your mortgage. Generally, shorter-term loans have lower interest rates than longer-term loans. If you can afford higher monthly payments, a shorter-term loan could save you a significant amount of interest over the life of your loan. Remember, securing the best mortgage rate isn't just about the lowest interest rate. It's about finding a rate and a mortgage that fits your financial situation and goals. Take the time to understand what you're getting into. Ask questions and make sure you're comfortable with your decision. Securing the best mortgage rate can save you a significant amount of money over the life of your loan. So, invest your time wisely in this process, and you'll reap the benefits later. Let's wrap up what we've learned about mortgage rates. We've journeyed through the basics, understanding that mortgage rates are the interest you pay on your home loan. We've discovered that several factors influence these rates, such as the economy, inflation, and your credit score. We've also explored the different types of mortgages, each with their unique rates. Fixed-rate mortgages offer stability, while adjustable-rate mortgages offer flexibility. We've seen that choosing between these types depends on your personal circumstances and financial goals. Lastly, we've learned how to secure the best mortgage rate. It's about doing your homework, maintaining a good credit score, saving for a substantial down payment, and shopping around for the best deal. Understanding mortgage rates is not just about numbers, it's about making informed decisions that can significantly impact your financial future. With this knowledge, you are now equipped to navigate the world of mortgage rates. Thank you for watching EXOUSIA Investing TV. See you next time for more keys to financial empowerment and insights for mastering the art of money management.